And of course, here this evening to present is Darren Farwell. Darren started his career with McLeod Young Weir in 1987 and set out to build what is today the Farwell Group, one of Scotia McLeod's top advisory teams, advising on approaching $1 billion in assets for clients and their families. Our team is dedicated to helping our clients achieve those things that matter most to them by providing planning, investment, banking, and tax-efficient strategies to make it happen. Please join me in welcoming Darren Farwell.
Thank you, Leslie. And hello, everybody. Welcome back. I mean, one of the things I love, I'm looking around and I know so many people here, which is wonderful. And a lot of people I recognize from last year, and there's quite a few faces I know were here the year before that, and the year before that, and literally for all the outlooks we've done, which have been quite a few. In fact, a dear client of mine came in earlier, and we were trying to figure out whether we'd been working together for 30 or 32 years. We weren't exactly sure. You know, we used to have at Scotia a tagline, relationships for life, and you know, I think that's a good way. You know, it represents really how we feel about things. Anyway, it's an honor to me that you've come back, and those who are here for the first time, some from the far north. I hope that we can deliver something that you find of value. So yes, welcome back. And I know from the faces that I see here that there are people with very busy schedules. And that's just another reason why I really want to express my appreciation, my respect for you taking time out every evening to come and share the evening with us, have a little, those appetizers were good, some good appetizers, maybe meet some people, but most importantly, get some insights, you know, some insights on things, well, that will affect your portfolio and therefore have an impact on your wealth, not only just today, but longer term. So with that, what are we going to talk about today? Oh, should have put that one up first. I love that cartoon. I think it was from Leslie. When is the bull market going to end? So today we're going to go through the agenda of, I'm going to provide some nuggets of what they call, you know, what collectively is called conventional wisdom. And I'm going to talk about how some of these ideas, these nuggets of conventional wisdom connect with what's going on today. Then we're going to look back at 2019. We'll take stock of where we are today. I'll provide an outlook of what we see happening in 2020. I'll summarize how all of those things tie in with the conventional wisdom we're talking about. And then very importantly, we've got two great panelists today, real masterminds of the Canadian investment business who are going to be here with us today. I'm looking really forward to that. At the end of that panel conversation, we'll have a Q&A. Really, we're not going to have much time for Q&A, 1, 2, 3 questions, but there will be the team, myself, and others available afterwards, and so feel free to ask us questions then. Conventional wisdom. So I said at the beginning that I was hoping, and my objective is to provide some insights into what's happening today in the market, what happened last year, and what to look out for. And the insights that I'm going to draw on aren't just the 34 years that I've been in the business, most of which was at Scotia McLeod. And frankly, I went to university and got a degree that touched on stock valuation, although it wasn't such a big thing back when I was in university. And then before that, I used to sit with my father on the weekends and he would go through the stock pages. I always made me very curious because he seemed to lose as much money as he made. And I wondered how all of that worked. Why would one be investing if you weren't actually making money? Didn't make sense to me then. Anyway, I'm not sure that it makes sense now, but not just that insight, and not just the insight from Leslie announced or was introducing our advisor team. There's over 70 years worth of experience on our combined advisor team. Not just insights from that group, but also the two very esteemed and specialists in their field of investments. But also the collective wisdom of all the investors who've been investing in the market for as long as there's been a market. Those insights collectively are this conventional wisdom. So I'm going to share some of those ideas, those conventional wisdoms, and relate to how they're impacting the market today. So what's the first pearl of wisdom, the conventional wisdom? It's time in the market, not timing the market, that creates long-term wealth. Now, I heard this from a client who's actually here today when we were talking later in the year, and it was clear that 2019 had been a very good year. Quite frankly, I've heard this statement, or one like it, 100 times. I've heard 100 different versions of it. You guys have probably heard versions of that statement. But for some reason, when he said it on the phone, sort of a light bulb went off and I went, what a year, 2019, to actually be the perfect representation of what this means, how important it is to just be in the market, because you never know which year is going to be the good year. Who remembers that period? September 2018 to December 2018. Quite a dramatic time, as a matter of fact, because on December 24th, the market, intraday, on December 24th, was down slightly more. Andrew could tell you exactly, but it was 20+%, but 20.49%. That's a bear market. That's big news, because if we're in a bear market, it's saying that there's a recession coming. But actually, the market didn't close there. The market closed at down 19.7. Not a bear market. Very exciting, interesting, but sitting there in December of 2018, was we thinking that 2019 was going to be a year of great profit? No, we're thinking that 2019 was going to be a year that was going to be one where we might even lose more money. Didn't turn out that way. Who would have known? Well, actually, I did a little bit. We'll see that in a minute. But really, it was not the consensus that 2019 was going to be a very good year, but it was. You don't know when the good years are going to happen, and the only way to really share in it is to be there when they do happen. You've got to be prepared. You've got to be ahead of the wave. We'll talk about that some more. It's time in the market, not timing the market, that creates wealth over the long term. So let's look back at 2019. It was a hot year, a red hot year. My forecast, when I stood here last year and said, what will 2019 look like? I suggested it was going to be a melt up with the ever-present possibility of a meltdown. Yes, I know what you're thinking. People on this side of the business are always, hedging their bets. But there's no choice but to hedge your bet right now. Because while we could see that there were factors in place that could potentially make 2019 a very good year, as you'll see in coming slides, we're late in the investment cycle. And because we're late in the investment cycle, we can have a meltdown at any time. We'll talk some more about that. But as we see, what actually happened? Well, it was a very good year. That's what actually happened in 2019. TSX, very strong returns. You'll notice that in the US and international, we've kind of got two numbers. The first one is the number in their domestic currency, and the second is translated to Canadian dollar. So that relates to further down the chart where you see the Canadian dollar did actually rise last year. A real reverse of trend, what had been for the last number of years, the Canadian dollar finally starting to get a little bit stronger. Well, it was a combination of the Canadian dollar getting stronger and the US dollar getting a bit weaker. But the Canadian dollar rose. Good returns, spectacular returns, right across the board. Canadian dollar went higher, interest rates went lower. Interest rates in the United States went dramatically lower. Interest rates in Canada really stayed the same. and the price of gold went up. Now, the price of gold, it's a store of wealth. When the US dollar declines and interest rates decline, there isn't a big opportunity cost for owning gold, so people will own more gold if rates are low, because you don't have to give up, getting interest if you left it in cash or GICs. So that's what actually happened in 2019. Now, how did our numbers stack up versus what actually happened? All right, I did say that I thought we would have a good year. If you look at the numbers that I'd forecast, I did suggest that there was a good chance of getting high double-digit numbers last year. Certainly well below what actually happened. The markets ended up doing significantly better than what I suspected, but we did think that we were going to have a good year last year. When we look at the dollar, we also thought that the Canadian dollar would rise, which it did a bit. Interest rates, however, were the big difference. Interest rates, as you could see, we were forecasting to go a bit higher. And as a matter of fact, you can see interest rates, particularly and most importantly in the United States, went down. So what were the factors that caused the market to do substantially better than probably we would have thought sitting here in January of 2019, but also even then my positive forecast? Why did we do even better? Well, if you remember 2019 at the start of the year, we had a couple of risk factors facing us. There was Brexit. That was still all over the map. No one knew what was going to happen there. Well, we got some resolution. It's not totally resolved, but at least there's a direction. There was the trade talks, the trade wars, we'll call it trade wars, trade talks with China. Tweets going back and forth, news stories changing. You never knew what was going on. And it is true that if the talks had really gone badly, it would have had a negative impact on corporate profits, would have had negative impact on global growth. It had been bad for the stock market. So we had reason to be cautious around what was happening with the trade talks. So those were important. And now, as we got through the end of the year, we sort of had some resolution on those fronts. Two other things were really important in 2019, though, that caused these numbers. And number one is corporate profits continued to increase. And number two, quite significantly, interest rates went down. One of the reasons why the market did so poorly between September of 2018 and December of 2018 was the view that Federal Reserve was going to raise interest rates. Instead, they lowered interest rates. Why is that so important? Why was that so important? Well, that takes us to another conventional wisdom. Don't fight the Fed. What does that mean? I'm going to connect the dots on this one. So I think it's really important. And that is, one of the things that you don't read a lot or hear a lot about is that the stock market over time, and this isn't a conventional wisdom, this is really a fact. The stock market over time is 100% correlated with corporate profits. If the corporate profits are going up, the stock market goes up. If corporate profits are going down, the stock market goes down. If the forecast is that corporate profits are going to go up, then the stock market will go up. If the forecast is that corporate profits are going to go down, the stock market will go down. Okay, what does that relate to interest rates? Well, when the Federal Reserve in the United States says that we're going to lower rates or maintain low rates, what it's saying is we want to stimulate the economy. We're interested in making the economy grow. We're going to push the economy along. Well, if they're stimulating the economy, then that means there's more demand in the economy. If there's more demand in the economy, that means there's higher prices. And if there's higher prices and borrowing costs are lower, guess what? Net, more profits for companies. More profits for companies, 100% correlation, stock market goes up. What happened in 29? All of those things. That's what happened in 2019 because we started the year thinking that interest rates would go up. Instead, they went down. So Bill Gross, one of the most famous and successful managers of fixed income and interest rates in North America over the last decades, says quite clearly, if interest rates are going to stay low, market's likely going to do well. Other real assets will likely do well also. I'm not an expert at all on real estate, but I'd venture to say that if interest rates stay low, real estate will probably do well also. So, interest rates, key. What is the Federal Reserve saying about next year? Sounds like they're going to hold the line. We don't hear many hints about them raising rates next year. Of course, they can change their mind. All right, that's why last year ended up being such a surprisingly good year. I mean, I don't know about, well, perhaps a lot of you here do get quite excited about the stock market. I mean, I absolutely, the stock market has everything. It's got excitement. It's got villains. It's got people who get rich. It's got mystery. It's got art. It has science. It has math. It's open all the time. It's global. I mean, the stock market has everything you could, I mean, it's so exciting. If the stock market had a body, I think I would marry it. The stock market is, and so I love this kind of thing because when you look at the stock market over the long term, it really makes sense. So let's take stock of today. What's going on right now today? Well, first off, you can see from this graph, it's the longest bull market. Well, that's interesting. Also, I know many of you have seen this graphic over and over because it's kind of my gospel of my stock market Bible, but this is updated. Look, we're getting very close to not only the longest bull market, but the biggest increase from the bottom. Getting very close. Okay, so what this says is that we're late in the investment cycle. One of those red lines is coming. I could have saved myself a couple of years of business school fees just by looking at this chart and going, okay, the stock market goes up, and then the stock market goes down, and then it goes up again. But what it doesn't tell you here or anywhere when you're late cycle is just when is that going to end? There's nothing there that tells you anything about when it will. And at the end of the day, bull markets don't end because they're long. There needs to be some catalyst for it to turn from a bull market to a bear market. Here's another way of looking at where we are in the investment cycle, and it leads me to another conventional wisdom. And that is the stock market climbs a wall of worry. You know, there have been a lot of things going wrong in the world since March of 2009, which was the bottom of the last Great Recession and the start of this bull market. A lot of things have been going wrong, yet the market keeps going up and up and up. It climbs the wall of worry. And it particularly climbs the wall of worry under a couple of circumstances. One, we know for sure for the market to be going up, corporate profits must be rising. Corporate profits have been rising consistently. Number two, we need to have low rates. Well, we've had low rates, and we've got even low rates seem to be staying low. And then thirdly, we have to have a lot of people who do not want to be invested because it's too risky. And why is it important to have everybody scared of investing? Because if everyone really is, by and large, afraid of investing or scared of getting too invested, that means stock prices won't get overvalued. Stock prices are at good valuations. So there'll be a constant demand for stocks at fair valuations, and the market just goes higher and higher and higher. That's been the case now for a long time, as you can see. Back in 2016, there was a big change in the market, similar to what happened last year. In 2015, the Federal Reserve said they were going to raise rates. In 2016, the market went down, and then after that, they said, no, we won't cause recession by higher rates. So the market's been on this phase 5 going up ever since. And whatever the headline was, the market seemed to recover and keep going higher because corporate profits have been rising, interest rates are low, and people are afraid to invest. You know, in 2019, investors as a whole bought more bonds than stocks. People are scared. That's good for the stock market. Now, I'll say though, we were talking to someone earlier here today who made a very astute observation about, I'm starting to sense a little bit, it's early, in the media and conversation, more discussion about how stocks are going to continue to go up, how stocks are really a good place to be, and you got to own stocks. I haven't been hearing that for a long time. I think what we're seeing is the very early stages of moving to a different level here. One of the things you don't want is exuberance. Because when you get exuberance, when the headline in the newspaper says, if you don't own stocks, you're an idiot. I know that sounds funny, but we've seen headlines in previous cycles that look just about like that. When your taxi driver and your hairdresser start recommending the best stocks for you to own, it's getting late, and it's time to think about whether or not there's exuberance. And if there's exuberance, that's probably much closer to the end. So we're already well past where the consensus was that we would move from a bull market to a bear market. But again, there's nothing there that says when it's going to end. Back in 2016, I put 2021. We'll see. That's after the next federal election. Can't have a presentation about the economy, particularly in the United States, without saying something about the president. He definitely is a point of conversation at parties, coffee shops, work, and just about any place you go. But one thing that President Trump has said is that he wants to be the president that ushers in the highest return in the stock markets of any president. He said that. And whatever we think about Trump, I think one thing we could probably agree, he's reasonably determined. And if he actually does that, there's a long way to go. But if he succeeds, there's a lot of money to be made in stocks still. We'll see. Remember, though, it's late cycle. I said earlier, when you're late cycle, when you're way up there, anything can happen to make it go the other way. The professor emeritus at Wharton Business School says the number one determinant of risk is where you are in the investment cycle. We're late in the investment cycle. The risk is high. Doesn't mean you won't make money over the next few years, but it does mean the risk is high. And when the risk is high, what that means is it's kind of like any straw could break the camel's back. Well, is it coronavirus? I don't know. Short term, the market has stumbled, but short term, the market's just waiting to see how serious is this. Because if it's really serious, then, yep, that's going to be bad for the market. We'll see. Certainly want to be cautious and stay tuned, though, because it'll be that simple to change the direction of the market. So what does all this have to do with you and your investments? Well, if you're a long-term investor with long-term savings and you're not particularly upset by market volatility, it doesn't mean anything. It's just interesting noise because you'll ride through it. However, many people, market volatility emotionally is a little more difficult, so we'll have to think about what to do about it. I love this chart, goes a long way back on the US market. We've been developing a big wave in the US market. Okay? It's a long way up. We know one day that wave will break. And just like the surfers, the surfers are riding the wave, but they always have that thing attached to the board, so when it does ultimately break, they're okay. They still have the board. I'm looking around the room, I've met a lot of you, and I know the other advisors on the team have met you as well. We're prepared. We were getting prepared in 2019. We're ready for whatever happens. So at this point, because you do want to be prepared ahead of time. Do you remember December 2018? When it crashes, it happens too fast and with so much force, it's too late to get off then. You've got to be prepared ahead of time. But we're ready. We are prepared. The next bit of conventional wisdom is it's good until it's not. It's rising, it'll keep rising until it stops, and then one day it'll be different. And for that time, you have to be prepared to make sure that the income you need to live on is safe on the sidelines. Make sure any big lump sum of money that you're going to need for something in the short term is safe on the sidelines. Otherwise, with your long-term investment money, get invested, stay invested at the level of risk that's comfortable for you. So what's our outlook for 2020? Well, the surge in 2019 has certainly suggests that there will be technical corrections in the market in 2020. There'll be consolidation in the market in 2020. All of that will dampen the mood a little bit. So while we're still looking at positive returns, they're much more modest. So single-digit returns. Still think the U.S. market, even though there may be a shift from growth to value stocks, so there'll be sale of growth stocks and purchase of value stocks, U.S. market is likely still to be the best market in the world, but other markets like Canada and international markets will be very close because even U.S. investors will start looking outside of the country to find their value stocks. Okay, so, but still good returns in equities, better than in cash and GICs, but with risk. It's late cycle, so there's risk. But let's face it, the only reason why you get longer returns in stocks over time is because there's risk. Embrace the risk, because that's why you get higher returns. If there was no risk, you'd get cash rates of return. So stock market's doing well. Canadian dollar, I think Leslie has said to me a few times, parity is something like to 80 or 82 cents. I don't think we're going to get to parity, but a combination of a weaker US dollar and Canada being okay, I think we'll get a little bit more strength in the Canadian dollar. Interest rates, Scotia is saying 1.8% on the 10-year US. It's actually lower than that right now. There's a real question whether coronavirus is going to slow down global growth or not. We'll see. But anywhere, 1.8 at the end of the year, not very far off where we are now. Canadian and Canada looks like the consensus is we'll cut rates 2 times. So borrowing should get less expensive in Canada. So that's interesting. And gold, again, a little more expensive. So that's the outlook for next year. Modest returns, high single-digit returns in equities, still a good place to be with your money that's got a long-term investment goal. I don't like to finish my presentation off without talking a little bit about, or restating rather, the power of dividends, the power of owning high-quality dividends from high-quality companies. There it is, the mothership, Bank of Nova Scotia. Okay, maybe it's not the best bank stock out there or hasn't been in the last couple of years, whatever. That's a pretty good 20-year average annual rate of return and tax effective because of the dividend. So just put it out there. So very good. The power of dividends is very strong, particularly if we're late cycle. So to summarize, timing the markets, not timing the markets. Long-term wealth is created by investing and staying invested over the long term so you capture those years where you have extraordinarily high rates of return like 2019. Markets climb the wall of worry. A good time to be invested is when other people are really scared of the market. It gets a little more dangerous and vulnerable when everyone wants in. Don't fight the Fed. We'll be watching interest rates. If the Federal Reserve starts to hint at the fact they're going to raise interest rates, that will be a very serious sign that probably the market may go the other way. It's all good until it's not good. You just don't know. That's why you've got to take the long-term perspective, but make sure the money you need is off to the side. And I'm going to add this one, which I haven't talked about, which is buy when everyone else is selling. Remember that bull-bear chart, red line's coming. At some point when we hit that red line, it's a great time to buy. So what I'm going to be talking to people about over the next year or 2 years is getting ready for that opportunity. We're already prepared for the market going down. We've done what we need to do. We're ready. We've been through it before. But when the market does go down, it'd be nice to be able to take advantage of it. There'll be real opportunity to buy when everyone else is selling. So now I'll ask Leslie to come back up because she's going to introduce our 2 panelists today. It's been a pleasure. Thank you for taking the time to listen. It's been a pleasure speaking with you, and look forward to meeting you all individually and talking about that opportunity when it comes up.